Good morning. Welcome to the morning market briefing. Today is Thursday, August 13th, 2026. Hope you're doing well. We do have producer price inflation that's going to come through. I am curious though, Tom, let's start off with interest rates. My view on interest rates, and I will reiterate this, I've written it, I've said it, I continue to believe it, and that is interest rates do not have to be as high as they are. And I think that it is creating a big fiscal drag for us. We just auctioned off 10-year bonds yesterday at the highest rate since 2007, 4.683%. And today we have a 30-year auction at 1 p.m. That'll probably be the highest, that'll go off at the highest rate, barring something crazy, since 2001. 2001, we didn't have a debt to GDP ratio anywhere close to what we have today. We almost had a balanced budget. We didn't really mind as much about paying 5% on our debt. When you have a $40 trillion in debt, 5% is a much bigger deal. And for that reason, I think that we should get interest rates down. Now, a lot of people will say, well, this is monetary financing and that's illegal and you can't do that. I would say it's kind of the reality of where we are today. And therefore, and if we have the ability or the option to have lower interest rates, we should try to get those interest rates down, because that is a huge deal for our financial flexibility now and in the future. That's my opinion.
I mean, for context, we, for a long time, we're considered the gold standard, right? In terms of like, when you talk about riskless assets from a credit standpoint, I should probably emphasize that for compliance reasons. The only riskless asset is the U.S. Treasury, and that's what everything is measured against. So right now, a 10-year bond is right at 467 for the U.S., but for countries that have been repeatedly penalized, had austerity measures forced against them, basically been forced to be subsidized by other European countries, Greece, Spain, Italy, Portugal. So Greece is only at a 380, Spain is only at 357, Italy is at 390, and Portugal's at 347. So you basically are sitting at a point where you can get 100 basis points more yield on a riskless U.S. asset than you can buying an equivalent 10-year bond for some of the worst run countries in Europe. And I think a lot of this is just a framing issue. I think people are misunderstanding the market. They're thinking that because they've been told that the Fed is making a mistake, Kevin Warsh is being reckless, they need to raise rates, and that that inflation is going to spiral out of control based on something that's going to happen that no one can actually point to, but for sure is going to happen. And so I think that we really need to be, it's such an opportunity. We need to be cautious here that the framing doesn't get to continue to get more crazy and more out of control. But interest rates now are as high or higher in certain tenors on the curve than they were the day Liberation Day happened, where the implication was that tariffs were going to make everything cost 5 times as much. We're going to have $10,000 iPhones and $400,000 F-150s. And all of those things have not come to fruition. In fact, the prices for most of those goods are actually lower right now. And growth expectations are actually higher. GDP now is printing over 5 right now. And the inflation number is roughly the same, if not slightly lower. So I think that all of the information that can be gathered from a data perspective is pointing one way, but everyone responsible for reporting that data is suggesting that it's actually going the other way, and there are very few dissenters. It's like there's no mothers for having 1, maybe 2 beers and then driving home safely. There's only mothers against drunk driving, and for the absolute punishment of anyone who would even consider having a cocktail while out at dinner with their wife on a date. So there's no pushback right now. There's absolutely no one out there rallying against this. I would call it fake news, or at least intellectually dishonest news. But we got the data in this morning for PPI, and guess what? It's pointing in the opposite direction of the way rates are moving right now. PPI month over month final demand expectation was 0.2. We came in at 0. X food and energy expectation was 0.3. We came in at 0.2. X food energy trade, we actually came in a little bit hotter at 0.4 versus 0.3, but the year over year number dropped to 4.7. And the core number went from 4.1 to 4.2, but that's down from 4.7 last month and 5.5 on the headline number last month. So we've dropped 80 basis points in month over month inflation. And this is going to be the piece of it because of the producer price index. That, think raw goods, wholesale goods. Oil is going to be a much heavier thumb on the scale for PPI. And so now you've had both sides of the economy, the wholesale side and the retail side, suddenly take a big step back in terms of inflation now 2 months in a row.
Well, and goods have been massive deflationary the last 2 months.
Yeah.
And it's really been services that have been higher. And the way they calculate services is so convoluted. So the first one, and this has been the subject of some debate, is portfolio management. Portfolio management PPI inflation was up 6.5%. That was driving overall PPI services higher. And then they also use margins in a variety of other businesses. And they said margins for health, beauty, optical goods retailing, automobiles and automobile parts retailing, lawn, garden, farm equipment and supplies retailing, food and alcohol retailing, food and alcohol wholesaling all moved higher. Their margins. Could that just be efficiency and productivity? Like, that doesn't have to be producer price inflation, but that's how they logically impute what the cost of what they're paying. And
yeah, they made more money, but guess what? Look at the other data. Nobody's really hiring. We're in a hire, don't fire jobs market, you could argue. And guess what? So what does that mean? The people who are working there have to work harder to keep their job, and that creates efficiency, which pushes margins, which, surprise, surprise, now is somehow inflationary.
The way they compute it, it's almost as if margins are going up, then prices have to be going up, because it comes from such a Keynesian biased framework. You come at it as the only way you can improve margins is not because of supply side productivity improvements moving down the supply curve. It is because you're charging more, which in some instances is the way that you improve margins. But sometimes you don't improve margins that way. Sometimes it's because of productivity. And I think that we're on a productivity boom that's getting undercounted because we're assuming that it's inflationary. Like, all this margin gain that all these companies are having, I don't know if that's all pricing.
Yeah, I mean, I think if anything, you could argue that if AI is working, this is how it should work. Companies should be able to make more with less because they're getting more efficient, because mundane tasks are now being entirely automated at a cost that for most companies is not going to be, it's going to be negligible. At the high levels, Microsoft and Meta, where they're using massive amount of compute, the CapEx is going to be large for future return on investment. But right now, I mean, I can tell you we do all kinds of stuff that used to take a long time. Now we can just push a button and we're good to go.
Yeah. I mean, I think it'll be really interesting to see what happens when over the course of the day, as people who not only are smarter than me, but also have way more influence than me talk about the PPI. My guess is they're actually going to spin this in a way that inflation is still sticky.
Yeah, they could be like, well, this is nowhere near 2.
Mm-hmm.
Say, all right, well, PPI is a smaller component of core PCE. CPI is the big one. It's running basically flat, over the last 2 months. This one has now not had an increase, and so core CPI is actually going to not increase.
Mm-hmm.
If they're both at functionally 0, then you can't have rising inflation if the two components that build the third component are 0 or negative.
What's interesting to me is that whole margin calculation, and I need to do some more work on this. But if you look at Cisco, who's forecasting margin declines over the next fiscal year, and they're down a little bit pre-market despite really good sales. They're seeing input cost inflation, but their margins are going down. So if anything, you think that tightening margins means higher producer price inflation. versus the opposite. So it's an interesting calculation that they make, but it has real implications on policy. And I think that's what Kevin Warsh is trying to fix, is that we want to measure the right things and have a good estimate of inflation. Because if we are going to haggle, right now the CPI is running at 2.5 on a year-over-year basis. If we are going to haggle over 50 basis points of inflation, we better make sure that 50 basis points is calculated correctly, because we're making real policy decisions based on that.
I mean, I would argue between 20 and 30 basis points really comes down to that housing number. I mean, if that's incorrect, which I would argue it is by a wide margin, I mean, almost 100% of that 3% increase is zero in my mind. You're looking at 2.1 at the most, assuming all the others are correct as well. And that's with elevated energy prices. Mm-hmm. I mean, I really think the move is to cut rates here. I really, really do. But there's absolutely no one saying that.
Yep.
If anything, like the real dovish people would be like, well, they don't have to hike until December now. But like, what's going to happen that didn't already happen? We've already had the huge supply shock in oil, and inflation didn't really tick up that much. What's the next shoe to drop?
I mean,
Putin can't start another war in Ukraine. That one's still going.
A lot of the margins are due to tariff refunds.
Yeah,
like that's not
exactly. Yeah, not, you got money for free that you were supposedly paying last year, which as we forget, led to 8% inflation, right?
Yeah. Oy. Lenovo reporting earnings they're up 20%. They're seeing a massive boom in this AI. I just wanted to talk a little bit about the durability of the AI. We mentioned it yesterday, and really the day before too, on the financing schemes. But I do think this is interesting. They're up 20%. AI-related revenues now 35% of Lenovo overall revenue. Tom, there was an interesting company called Lambda. And we're going to continue to pick these apart as they come out over the next 6 months, because I do think this is one of the topics of financial innovation, financial engineering, that is going to potentially characterize the next 10 or 20 years in, they like to say, financing. And Lambda is doing exactly what we suspected that people were going to start doing on the call yesterday. I didn't realize it was going to be so soon. But they're coming out with a 4.4-year term loan that amortizes down over the course of 4 years. And it's trading at 300 basis points. It was just priced at 300 basis points over SOFR, which works out to about 6.6% or so. I think that based on this and the appetite for this debt and the structure that so apparently so easily went down with the market, I think that we're in the early stages of financing this whole ecosystem. And for that reason, I think you saw a huge rally in a lot of those related companies yesterday, and also a decline in some of the software stocks, because I think some of those software companies were boosted by the idea that people are running out of capital to spend on this AI innovation. And this is saying, no, in fact, quite the opposite. We're broadening out the capital base, which is going to make the AI trade more durable. And so I just try that on for size in terms of a thesis. And I think this is a $965 million. It's very small in the idea of bond issuance, but it's something to consider going forward as a new asset class, perhaps.
I mean, I think one of the reasons people have a hard time wrapping their minds around bonds is because in reality, your traditional bullet corporate bond is actually a pretty unusual structure for debt for the average person, because almost everybody who has debt, car loans, mortgages, they work on an amortization schedule. You know, every month you pay principal and interest. Yeah, and you know on a car loan it gets smaller over time, but if Apple borrows money, they borrow $40 billion that's payable, and they have to pay that whole $40 billion back in one shot in 10 years, plus pay interest over the time period. Like, people aren't going out and buying, for the most part, balloon mortgages where it's like, oh, I'm going to borrow $800,000 to buy this house and pay just the interest, and then at the end I've got to pay that $800,000 back or sell it. And so I think this is actually, I don't know why it took us so long to get here, but probably a good way for companies to borrow money over time, because that's how you build wealth in your house, is that you start with a high level of debt, and after 10 years, the asset is still worth what it's worth, maybe even more, in most cases more, and you owe a lot less on it, and that makes it easier to extract your money out of it. So I wouldn't be surprised if we see more of that. And if you look in other countries, a lot more debt that's issued outside the U.S. Outside of the U.S. is either amortization debt or it's floating rate debt, and so that you can either get bailed out by lower interest rates or punished by them. And we just don't do that in scale here outside of mortgages and sort of your more retail ABS like car loans or credit cards or things like that. And so I think it's just the next logical step. I mean, it makes sense for a business to be able to generate wealth by saying, hey, I'm going to buy this asset, and then over time it's going to be worth more and I'm going to owe less on it.
I think the edge is going to be access, because I mean, we all know the Schwabs and the Fidelities of the world will drag their feet on this, because they're going to say this is too difficult for our clients and it's too difficult for us to put on our system, and therefore we're just not going to play in there. You can buy your treasuries, you can buy your investment grade corporates, but we're going to try to hide this as much as possible and not show you any inventory. And I think that that's going to be tricky, and it is a little bit more mathematically intensive, because it's basically a moving target versus a bullet bond, pays interest, and it's finance 101. Yep. It's very easy for people to understand. This is a little bit more math intensive, but it's not difficult. I mean, I think Schwab and Fidelity are insulting the intelligence of its investors if they don't offer these things.
Yeah. I mean, we bought a lot of floating rate munis during COVID, and those have performed like a dream and continue to, because the Fed has not cut interest rates. But though you can't buy those at a retail level, you have to go to a trader to get those. You have to go to specialized inventory holders. And I think that's how it's going to be with some of this ABS, is that you're going to have to, Schwab is not going to let the average retail advisor buy these because they can't guarantee you even know what you're buying. And there's going to be moving parts. I mean, mortgages are like that. You have to really be up to snuff on your bond math to understand how to buy those and which ones are good and which ones aren't, which I think is an advantage for us as we start to get more clarity on how these are going to be structured. But I mean, we talked about it yesterday, the enhanced equipment trusts, which are the airplanes, planes, trains, and automobiles. You can't buy those anywhere. You have to buy them from a trader. I mean, you start to get in these esoteric areas of the market, but bond world is not like stock world. There's the fewer eyeballs are on a specific space, the higher the bid-ask spread, which means that you can get it for cheaper. And as long as you make the correct choice, you will get more spread, more yield. But the problem is the liquidity factor on it is lower. And so you need to be careful of that as well. And especially say you buy an ABS bond, it's got 4 years, and 3 years later, the client wants to sell it. What originally was $50,000 hypothetically, and now it's 12 because it's burned off a lot of the principal and interest. It's like, who's in the market for a 12 bond piece that's attached to these chips? Probably very few people. And so you need to be careful about being nimble in the accounts as well, where you've got these basically 3 puffs left on the cigarette. Somebody's going to want to smoke it, but it's not going to be your classiest people. People just walk around picking up other people's cigarette butts if they don't have to. And that's where you kind of run into the problem, is you're going to end up with these, leftovers that are hard to sell. You've made a lot of money on the front end, but you might have to take a hickey on that smaller piece. But if you're front loaded in the yield, it doesn't really matter that much if you give up a point or two on the sell, because you've already amortized off a lot of that yield. So it's going to be an interesting mixed bag, but I'm excited for it. I mean, I think that's why I like mortgages, because it smooths out the income. Mm-hmm. Instead of getting paid, every 6 months on a bond, which is the standard structure, every month you get principal interest. You get some of you get a gain and a return and some of your money back every single month. And if you stack enough of them, now you're getting paid every month, not on the corners of the year like munis or corporates, where most of them are 1, 3, 6, 9, 12.
If you're concerned about the credit quality of the borrower who's paying you, it's pretty nice to get a little bit of your money back every month.
Yeah, you de-risk much faster than I'm going to get all my money back in 10 years. It's like, well, I'm going to get a little bit of my money back every single month for 4.5.
Yep. Elsewhere in AI world, Anthropic is now targeting a more than $2 trillion valuation, and I expect it to be well north of $2 trillion, maybe 2.5, due to market share gains, market growth. They would, top SpaceX double its valuation from May. May, they raised money at a $965 billion valuation. This will go out for more than $2 trillion. They expect annualized revenue of $100 to $120 billion at the end of the year, which everyone's kind of trumpeting as, man, this is really, really impressive. They're definitely justifying it as actually cheap at $2 trillion. SpaceX just provided guidance that they're going to annualize revenue at $100 billion by Q4, or by December at least. So Anthropic, not that much different from SpaceX's guidance. Now you can...
And revenue is not profits.
Right. Now you could argue that SpaceX is not actually going to get there, and Anthropic will, but then you're just making a judgment on... Then it's just kind of...
That's the game, right?
That's the game. So... Interesting. Other AI companies like Palantir have traded at 25, 30x plus revenue. So by that letter, yes, a $2 trillion plus valuation could conceivably make sense for Anthropic. It does seem like more and more people are using multiple AIs for different things, including using both Claude and ChatGPT's codex. We're seeing people kind of go back and forth between models and identify which are working well. So I'm expecting Anthropic's IPO as soon as late September, maybe October. But I don't expect it's going to take a long time, especially with the ability to raise capital that we're seeing in the market right now. Maersk, the big international shipping company, they're up 7%. Just wanted to bring this to everyone's attention. They say global electrification is one of the key drivers of shipping demand, which they say is just really resilient. Increasing shipments of batteries, air conditioners, solar panels, windmills, turbines, electric grid, anything that has to do with electrification, data center. They say what's really interesting here is that although they've basically seen market demand continue, quote, unabated, despite the war in the Middle East, the tariffs, etc., they say what's interesting is the mix. They've gone from a few years ago, they were importing or exporting from the Far East general department store goods like, they say, furniture, footwear, clothing, and foodstuffs. And now they're doing kind of batteries, storage, electrification, etc.
Air conditioners. It's like almost like Europe.
Yep.
You got a wake-up call there.
So... really interesting report from them. But again, this kind of goes to show our view that manufacturing, the industrial side of the economy, is having a moment. And it's the beginning of a moment. These cycles don't last a couple months. This is not an inventory boom. This is not a COVID. This is a cycle. And I think we're in the early innings of it personally. Something could derail it, but it's got some momentum. It's got some powerful momentum, despite all of the headwinds that exist.
And we basically were in a decreasing scenario for what, 7 years before that.
Mm-hmm.
So once the engine gets going, it's going to be hard to stop because now the investment will kick up. The more investment goes in, the more that's going to prolong that in what was essentially a dead half of the economy for a very long time.
Indeed. We'll see you tomorrow. Have a great day. Bye.